My name is Andrew Stotson. I want to welcome you to the Valuation Master Class presentations. Uh, this presentation is a valuation report on Tesla. It's been a while since we've looked at Tesla, so what a great opportunity to understand more. The student who's going to be presenting this is doing this as a final assignment for Valuation Masterclass. So let me bring her in right now. 1 second. Meta, are you ready to go?
Yes,
Pretty exciting. Just
yes, it
seems like
is.
6 weeks ago I saw you up here graduating from the boot camp, and now here you are back.
That's
Exciting.
right.
I'm looking forward to an even better presentation than the one that you did last time.
I hope so too.
I'm sure it will be. First, let me just bring that screen up 1 second. There we go. Okay, so now we see the presentation of Tesla, and we see you and me on the screen. So I'm going to take myself out, and then you just take it away, all right?
All right.
Okay, so I'm taking myself out now, and I look forward to it. Go.
Good afternoon, everyone. I'm Medha Agrawal, and today I'm here to talk about my equity research report on Tesla. I initiate coverage on Tesla with a sell recommendation based on a target price of $217, implying a downside of 37%. I derived this target price from a DCF based valuation using a WACC of 10.5% and a terminal growth rate of 4%. As a glimpse into what I'll be talking about, a few highlights are the rising volumes and falling selling prices with improving margins, the the manufacturing capacity, financial and operating capability for growth, as well as the overpricing due to the Elon premium, which is unsustainable and disregards the risks like radical decisions by the CEO, no streamlining of procurement, operations, and timelines, failure of new products, and as well as competition from established manufacturers as well as new entrants. Um, so Tesla was started by two engineers in 2003, and Elon Musk, who was an early investor and board member, took over as the CEO in 2008. They released the first EV, the Roadster, in 2008 and have since released four more cars as well as the Cybertruck and Semi models. They also sell charging equipment for EVs and solar based energy equipment and operate in 51 countries wherein they have 50% wherein they have about 50% market share as Tesla leads the EV industry and the EV revolution. Going through the highlights of my valuation, Tesla. So in the US, there are three best-selling EVs, which are Model 3, Y, and Cybertruck, which shows Tesla's market dominance already. They'll continue releasing new products like these, with such as the mass market EV, which is expected into mid 2025, as well as production. However, revenue growth also faces the downward pressure of lowering selling prices and a product mix focused on lower priced models as well as fierce competition. Because of these factors, the gross profit also faces a downward pressure. However, it is combated by the company's commitment to reducing COGS, which came to a low of $35,100 per car in the last quarter. I expect that this decrease will continue because they're expecting a 50% manufacturing cost cut, as well as are as well as seeing revenue growth in their subsidiary segments of energy generation and storage as well as services. Secondly, Tesla currently has a manufacturing capacity of 2.35 billion vehicles at its 6 gigafactories as well as two factories for battery manufacturing, and it is now planning to build another in Mexico by 2025, making a lithium refinery to increase supply of batteries, and is expanding the Nevada and Berlin factories. ha- Having a strong balance sheet with sufficient cash and negative net debt to equity along with this ensures that the company will not face a financial crunch and will go for these expansions, hence adding a capacity of 2.5 million EVs, batteries for 1.5 million vehicles, and 80 gigawatt hours of lithium. However, the stock also sees overpricing, since investors often treat investing into Tesla as a proxy for investing into Elon Musk himself, which means the Elon premium is a key factor in Tesla's pricing. This makes the stock volatile because of Musk's actions rather than resulting from a change in the company's fundamentals themselves. So it comes with its downsides such as stock volatility, delayed production timelines, and all other downsides of of having a part-time CEO in the company. Let's now take a look at the P&L numbers from the past few quarters to have a better understanding of this. We see a 7.8% YOY increase in revenues due to higher deliveries and increasing gross profit margins, and increasing gross profit since, as we saw before, they reached a low of $35,100 per in manufacturing cost per car, because as a result of this, net profit increases as well. Also, in latest news after this quarterly data, we see that Tesla is planning to launch new, more affordable vehicles in 2025, including the Model Y Juniper and the autonomous Cybercab. The the Trump administration has brought both positives and negatives. Positives like higher influence since Musk is the head of one of the government departments, and negatives because they're expecting tariffs on products from Mexico and elimination of the EV incentive. As a result, Tesla stock surged about 40% post election results and added $350 billion to the market capitalization. But where does this increasing revenue that we see come from? Well, 85% of it comes from the automotive segment, with from automotive sales revenue from its various models, as well as revenue from the sale of regulatory credits to other automotive companies and automotive leasing sale revenues. 9% of the revenue comes from sales and other sales from services and other, such as warranties, body shop and parts, supercharging, etc. And energy generation contributes 6%, with solar energy being the major focus here. Of this, 47% revenues are coming from the US, 22% from China, and 31% from other countries. On the other hand, I also considered what constraints are there possible after considering those growth drivers. So capital is only a minor constraint since Tesla has about $29 billion in cash and cash equivalents, while its capital expenditures are only $9 billion in comparison to that, as well as has decreasing debt which allows it to borrow more. Secondly, operations are a major risk because parts are though procured from a large number of suppliers, some of these are procured only from single sources, which may cause a risk because backward integration is difficult and time consuming. Also, 40% of their production capacity is in Shanghai only, which and Shanghai poses major supply chain constraints, which may be a risk going forward. Market is only a neutral constraint because global EV sales have grown to $40.5 million and have 40.5 million units in 2023, and this trend is projected to continue, with EV sales accounting for one-fifth of the total passenger car sales by 2035 in the US. However, it is still is still a fluctuating and unstable industry with problems like technology constraints and affordability. For Tesla, people are a major constraint because it depends immensely on Elon Musk since he controls the entire operations, innovation, and provides much needed direction to the company. Further, I evaluated Tesla in comparison to 1,810 non financial companies in the USA and found the shocking result that it ranks in the bottom 10%. But when I looked into it deeper, I understood why. In fundamentals, it ranks in the top 40 due to cost efficiency, while in valuation, it is at the bottom 30% because of high PE and high PEG ratios. Uh, However, most of its low ranking comes from its high risk because of a high beta of 3.0, since it operates in a tech first manner along with share price fluctuation according to market sentiments. Another framework of evaluation I used was the Porter's 5 forces, on which Tesla scores 65%. For rivalry among competitors, it sees a score of 80% since competitors like Rivian, BYD, Volkswagen, etc. are emerging and However, the EV car sales have grown by a CAGR of 58.7% in the past 10 years, and there's major technology disruption in the areas of battery technology, autonomous driving, cost efficiency, etc., going on in the industry. For bargaining power in relation to suppliers, they score at 53% because though they source from 300 suppliers, some of their materials come from very specific suppliers, which it is difficult to switch from them because they're very technology and R&D heavy. As an example, they uh, collaborate with Panasonic in one of their factories, and it would be very difficult to switch from Panasonic as a supplier of batteries for them, because uh, so even backward integration is something that's very time consuming and R&D heavy for the company. However, it is still possible, as it has happened for batteries, the self driving system, and is now happening for lithium as well. About bargaining power versus customers, Tesla scores at a 40% because it is having to reduce its pricing due to customer demands to remain competitive. However, since its net promoter score is 97, it indicates that most customers are still loyal to Tesla. The threat of new entrants is at a 67% because Tesla has really high economies of scale, and Tesla sells innovation, which gives it a major moat around its business, which is difficult for any new entrant to penetrate into. As of threat of substitutes, it is at 87% because it is difficult for customers to switch once they've made a purchase, especially since Tesla makes its products stickier by creating an entire ecosystem of servicing, charging, self-driving software, etc. I then considered the world-class benchmarking framework, which placed Tesla in the top 10% of 910 large consumer discretionary companies for profitable growth. This comes from the excellent profitability of 10% of top 10% in the last 4 years, although there is a lot of room for improvement on the growth side of things. Here we see a deeper look into these with a decreasing ROA, declining EPS growth, average asset turnover, high net margins, a huge drop in sales growth in the past 12 months, and fluctuating net margins. Now that we've seen the quantitative aspect, let's also take a look at the qualitative side. Tesla is, of course, is the CEO, and the chairperson is Robin Denholm, of a board of 8 directors, of which 8 are independent, which is far lower than the average for USA and North America. Tesla's Tesla is majorly owned by institutional investors, forming 46% of the ownership, with investors like Vanguard, BlackRock, State Street, etc. While 21% is owned by insiders, of which 12% is held by Elon Musk, 14% is by ETFs, 14% is by mutual funds, and 18% is by ETFs. I then considered the ESG factors on which Tesla scored at 53%. For environmental, it is at 60% because because the company is committed to reducing water usage, energy usage in factories. However, its Fremont factory has received more than 100 air quality violation notices, because of which it has had to pay a lot in fines. On social, it scores at 80% because it's rated more than 90% on product safety metrics. However, it has often been forced to recall its products due to defects in them. On governance, it scores at a low of 20% because only 62.5 of its 5% of its directors are independent, and Musk was accused of insider trading in 2022. um Having taken all of these factors and fundamentals into consideration, I then valued it as follows. I estimated increasing revenues more than doubling by 2028 due to the following factors: launch of new products with new features that aren't available anywhere else in the market, for example, the RoboCab with its full self driving technology; lower selling prices, hence acquiring a larger market share; and increased revenues from the energy storage and services segments. I also estimate increasing gross margins because of further lowering of manufacturing cost, especially since Tesla will have to procure less from suppliers, as is happening in the case of the lithium factory. This will ultimately then result into an increasing EPS. I expect Tesla will have increasing accounts receivables because they're increasingly providing financing and leasing options to customers. And as I've talked about before, their net fixed assets will grow because of their investments into gigafactories and refineries, especially to accommodate for increased volumes and larger product lines in later years. Tesla has only had 0.1% in debt to equity ratio in the past few years, and I'm expecting that to continue in the near term. But how this does allow Tesla to raise a lot more long term debt to finance its operations. However, the major funding still comes from retained earnings. Here, I expect Tesla will eventually start paying out some amount as dividends because of its large revenues and increasing cash reserves, even after comfortably spending on their capex. Here are a few of the ratios just to reinforce. The gross margin is increasing. We see constant debt to equity and increasing revenues as has been taken in the assumption so far. These numbers finally resulted in the following increasing FCFF and FCFE estimations. I then considered the relative valuation through which I found that Tesla is priced extremely high on the PB ratio, PB to ROE ratio, PE ratio, as well as PEG ratio, despite considering high EPS growth. Here are the assumptions I took for the WACC, considering a risk free rate of 2.5%, a company beta of 1.2, resulting in a COE of 11.7%, and then taking 3.7% as the cost of debt, which brought me to 10.5% in WACC, which then resulted in the base equity value of 217 per share. I also considered the highest possible price by FCFF, which came to $245.3 if the terminal growth rate changed by 1%, and the highest possible value here is $307 by PEG ratio if the sales growth increased by 10%. Uh, Now that I've explained to you the benefits, let's also take a look at the risks. Um, the radical decisions by the CEO, such as his controversial opinions and actions, like his Twitter acquisition, because of which we saw this extreme uh, s- decline in the stock price, his promotion of Trump's presidential campaign, comments on social media, and other general publicity around him, leaves a leaves a lot of risk for Tesla as a company. Also, the company sees no streamlining of procurement, operations, and timelines, since many of its vehicles have been delayed by a lot of months post their expected release date. Since it's a high tech company with untested, untried products, it there is a possibility that all of their money spent on R&D turns into a sunk cost, and they have to recall their products because of technology failure. And lastly, competition from established manufacturers like General Motors or new entrants like Rivian, as well as competitors like BYD, have which surpassed Tesla in revenue in the last quarter, pose a major risk, even though Tesla currently holds a major market share. To conclude, and as a final recommendation, I believe Tesla is currently overvalued and hence give a sell recommendation with a downside of 38%. However, at its 52-week low price, this target price would result into a 57% upside. So even though it is overpriced now, its optimistic growth outlook makes it a great investment for the long term. And that is my recommendation for Tesla. Thank you.
Excellent. Can you just repeat that last part you just said about the long term?
Right. So, I at present the stock price is $351.
Yep.
However, its 52-week low was around $150. So at the current price, my target of $217 will result in a 38% downside, but at that 52-week low, it will result in a 57% upside, which shows that the company at its core, at its fundamentals, is really good and is having an optimistic growth outlook. However, because of the market sentiments, the share price fluctuates a lot, which makes it overpriced at the moment.
Okay. Can you go up a couple slides to your valuation slide?
Sure.
Oh, go down. Keep going down. Next one. Yeah, that one. Uh, so the
Yeah.
valuation one, not the sensitivity one. Okay. So basically, you're using a discount rate of 12%. Even if you brought that down, I guess it's still. So let's say the your value is roughly about 200%, or sorry, $200 roughly, let's say,
Right.
between the free cash flow firm and free cash flow to equity. Um, it's incredible how high the price is relative to that. One thing I thought was interesting, can you go up to your ratio page?
Yeah.
What I think is interesting is, as you said, the margin's rising, but actually the margin has been falling. Look at 2021, 2022. So Tesla made some big changes in 2023, reducing prices, and you know, uh, so that brought down its gross margin to 18.
Right.
What
So its COGS has been falling because it has been like decreasing its manufacturing cost per car, but the gross profit margin is showing a decrease because of their lower selling prices, because they're selling more of Model 3 and Model Y, which have a lower selling price point.
and one of the things that's interesting about this is that it seems like maybe we passed the bottom at 17.4 in March of 2024, first quarter. And now they're making a recovery back from that.
Yeah.
So, and what's the potential? Can that come up to 25 where it used to be? Or do you think the 19.8 that it hit in September is as far as it goes?
I think it can come up to a 25% because, like I said, they are expecting to cut about 50% of their manufacturing cost, and they'll be able to do that because, like, they'll reach higher economies of scale. They'll get more of their raw materials under their own manufacturing, own supply, because like they're doing in the case of building a lithium refinery. So they currently procure lithium from outside suppliers, but since they have their own refinery, it will cost them lesser. So things like this will result in very low COGS, which I think will lead to the gross margin reaching up to 25%.
And is 35,000 per car, is that the lowest of US car makers?
uh it is it is close to the lowest, like, even so in US it is the lowest. In China, I think there is BYD is having a lower manufacturing cost.
And it's interesting because that Musk has a lot at stake if something goes wrong with the US China, relationship. How do
Right.
you rate the risk of that, happening, and what could it mean to your valuation?
I think that is a pretty major risk here because like about 20% of their revenues are coming from China. They have one factory which has a 40% of its production capacity. So Tesla's 40% production capacity is in China, which means that if relations between US and China turn bad, it will cause a very huge setback to the company. Um, right now, the Trump administration is considering to put taxes on on imports from Mexico. So, because of that, their plans to put up a factory in Mexico are also on hold. So, that kind of impact is there, which is why I think bad relations with China would pose a major risk.
So how does it feel to graduate from Valuation Master Class?
It feels great. It feels much better than it did to graduate from boot camp.
So tell us about what's the difference between what you know now compared to what you knew at the end of boot camp. So 6 weeks for boot camp, now 6 weeks for professional, where you valued 9 companies or so. What's the difference in how you approach valuation and the like?
Right. So in bootcamp, we just did one company. We spent 5 weeks on that one company. In professional. We've been doing 9 companies in 6 weeks, and switching from company to company has been such a hectic task. Keeping it clear in your head which research goes where, what impacts what, how. I think the change it has brought in the way I research is, I during boot camp I just looked at whatever information the company provides. During my current valuations, I look a lot more at surrounding news, at what other analysts are thinking, um, and all of those factors. I form a lot more of my own opinions rather than just going by whatever the company is saying.
And what would you think is the role of the feedback that you get, in your valuations? How did that help you?
Yeah, I found that really helpful because when I was valuing Costco, I didn't know where I was going right, where I was going wrong. Now that I had that sort of feedback, just yesterday I was going through through like my third valuation or something, and I saw that I'd made an assumption that is so out of bounds. I was like, why would I even make that assumption? So that's the kind of change I've had with the feedback, because of the feedback that we get on each valuation, making 6 to 7 drafts for every single company.
And how would you rate the usefulness or the value that you got when you started giving feedback to other students?
I found that to be really helpful as well, because then when I was starting to see loopholes in their valuations, I started realizing that those loopholes exist in my valuations too, and I started to correct them before I even had to ask for feedback to get to the correct estimates.
Mm-hmm. And what is your future plans, just for the audience out there that is looking for smart young people like yourself?
So I am currently pursuing my undergraduation from SRCC, which is a college in Delhi University in India, and and alongside that, I'm pursuing chartered accountancy.
That's why Zishan said, "Good work. SRCC is known for intelligence, and your work was just like that."
Thank you.
All right. Well, I'm super proud of what you've done. It's no easy feat to get to the end of the total valuation masterclass. So well done. And I'm gonna sign you off now. But just you know, time to relax and enjoy what you've been able to accomplish. So well done.
Right. Thank you.
Yep. Pretty incredible. Probably spent 400, maybe even 500 hours in 12 weeks to complete Valuation Masterclass. And what a great demonstration of her skills. So Meta is going to have a great future as an analyst, as a fund manager, as an investment banker. In fact, you may want to hire her. For those people that want to build valuation as a competitive advantage, why not come and join us at valuationmasterclass.com?